Thank you for joining me this Friday, the 15th of March. I'm Grady, market analyst with Bell Direct. All eyes were on the US this week as the release of key economic data provided insights into how the world's largest economy is faring on the inflation front, as well as providing an outlook for how the Fed may respond rate-wise in the months to come. Firstly, investors took confidence in the slight rise in inflation through the latest CPI data, indicating core inflation rose 0.4% in February from January and 3.8% year on year, while the inflation rate itself in the US rose just 0.1% to 3.2% in February. While the inflation rate was slightly higher than economists were expecting, markets responded positively, with investors finding reason to pile back into the Magnificent Seven this week, and specifically Meta and Nvidia midweek. US retail sales rose 0.6% month-on-month in February from January, but were below market expectations of a 0.8% rise, which is a positive sign for the Fed to cut rates soon, as consumer retail spend is a key indicator of inflation. The biggest increase in spend came from building materials and motor vehicles, which indicates consumers are spending on larger goods front as opposed to low-ticket fashion retail spending. In February, the producer price index in the US, which is another key driver of inflation, rose 0.6% month-on-month from January, which is the largest increase since August 2023 and doubled market expectations of a 0.3% rise. With goods prices rising 1.2% over the month, this is a conflicting indicator to the slowdown in retail spend and suggests that inflation on the producer front continues to rise, thus adding to inflation remaining sticky in the world's largest economy. Services inflation is another key driver of inflation, and the cost of services rose 0.3% over the month of February, which also presents as a significant factor for the Fed to consider at the next FOMC meeting. With this in mind, the market pricing in any interest rate cuts by the Fed in the very near future may now be in doubt, as inflation-related data indicates inflation remains sticky and above the US target of 2%. While investors are aware that inflation may remain elevated for some time to come, they are still optimistic that rate cuts are on the horizon, both out of the Fed and around global central banks, as economies continue to struggle through the currently high interest rate environment. On the local market this week, it was a mining giant sell-off as iron ore slumped to $111 a tonne, the lowest level since August last year, due to ongoing demand weakness out of China, the world's largest importer of iron ore, causing stockpiles of the commodity at ports around the world, and on news this week of further production cuts expected from Chinese steel producers. BHP fell 1.5% over the last 5 trading days, FMG lost 5.85%, and Rio Tinto fell 1.15% over the same trading period. A few latecomers also released earnings results this week, including department store giant Myer, which reported total sales down 3% to $1.829 billion. EBITDA fell 10.4% to $215.7 million. NPAT declined 19.9% to $52 million. And the cost of doing business rose 1.6%. The fall in sales was largely due to store closures, while online sales lifted 2% to $390.1 million. Management attributed the tough macroeconomic conditions to the poorer results over the first half. Board changes and outlook, though, boosted investor sentiment, with Myer shares rising 4.5% over the trading session on Thursday after the results were released. Comparable sales for the first 6 weeks of H2 FY24 for Myer are also up 4.9%, indicating recovery in the consumer spend with Myer. Locally, from Monday to Thursday, the ASX 200 fell 1.7%, led by a sell-off in the energy and utilities sectors. The information technology sector offset some of the losses, though, with a gain of 0.55% across the 4 trading days, taking a strong lead from Nasdaq on Wall Street this week, as investor appetite regains momentum for the high-growth sector. The winning stocks over the 4 trading sessions were led by Arafura Rare Earths, soaring over 67% after the Federal federal government conditionally approved a $533 million debt finance package to support Arafura's flagship Nolan's NdPr project. Jervoy Global rose 33% this week, and Vulcan Energy Resources added 30% over the 4 trading days. And on the losing end, Lake Resources fell 27%, Cockle lost 22%, and Aussie Broadband dipped 21.5%. On the broader market, the All Ords closed the 4 trading days down 1.65%. The most traded stocks by Belderac clients from Monday to Thursday were CBA, Westpac, and BHP. Clients also bought into Zip and Metcash while taking profits from Goodman Group, Quantum Intellectual Property, Propel Funeral Partners, NAB, and Bannerman Energy. And the most traded ETFs were led by Vanguard Australian Shares High Yield ETF, BetaShares Geared Australian Equity Hedge Fund ETF, and BetaShares Global Shares ETF. On the economic calendar next week, Australia's all-important RBA interest rate decision is announced on Tuesday, with the expectation of a hold at the current rate of 4.35%, likely due to inflation of housing prices, wages, and PPI remaining elevated. Overseas, key economic data out of China will provide key insight into how the world's second-largest economy is faring in the post-pandemic environment and the low economic growth environment. China's retail sales data for January-February is out on Monday, with the expectation of a decline in sales to 5.3% from 7.4% in the prior period, which paints the picture of ongoing economic slowdown in the region. Industrial production data in China is also out on Monday, with markets factoring in a decline from 6.8% in January to 4.9% in February, also providing further evidence of a continued slowdown in economic activity in the region. In the US, the Fed's latest interest rate decision is out on Thursday, with economists expecting the maintenance of the current interest rate as inflation does remain sticky in the world's largest economy, as shown by CPI data out this week. And that's all we have time for today. Have a wonderful Friday and weekend, and as always, happy investing.